I want to welcome everybody to our webinar tonight. And one of the things that we're going to cover tonight is the new model that we're rolling out, which is the two-egg strategy. And as we go through this tonight, one of the things I want you to understand is that, we don't have all the answers to the market. Would be the last person to actually profess that I have. My focus is how do I be a better trader? How do I help others become a better trader? And what we share on the website is really what we do every day. I mean, we manage money on a professional basis, so this is what we're doing. This isn't, pie in the sky baloney. This is actually our business, and so I take a lot of pride in it, first of all, but second of all, is that it's real to me. It's not something that I sat in a closet and thought of and was bored looking for a second career. This is my career. It's been my only career outside of teaching high school and college. So it's the one thing that I know is trading and investing, and it's really, doesn't make me great. It just means that this is the one thing that we've been able to do successfully. So with that brief intro, what do I talk about what do I mean by one egg or two egg? I know some of you have discovered that we have a one egg strategy as we announced this webinar, but all it is that the one egg strategy is based on momentum. We're looking for acceleration, whether it's off of a bottom or acceleration off of a top to the downside, which would be short trades. And it can be any number of things. We can see breakouts of patterns from a technical perspective, but we're definitely looking for acceleration, and we have about 8 or 9 different strategies within that. Sometimes we use even more than that, but we use predominantly on a day-to-day basis. There's probably 5 predominant strategies that we focus on with the egg. And those same strategies apply to the two egg, which we're going to talk about, which is essentially setting up a pair trade. So that's what we're going to look at tonight, is how we do all of that. So this allows you, I think, really to focus. And as an intro to this, I think it's important that you understand the psychology of trading. And when you look at this, the psychology of trading to me is probably about 80% of trading, and that you've got to deal with the 6 inches between your ears. For some of you, there's a lot more inches because you have a bigger head, but that be as it may, I think that when you look at a chart, and we look at charts all the time, and you look at these charts, they're a picture of things that have happened, and they tell a story. The key is understanding that there's 2 parts of a market. There's what's happening inside the market, which is technical and fundamental data, and then there's a part of the market that's happening outside the market, which is your economic data. It's emotional things. It's trends within the environment. It could be present. It could be political. It could be It could be geopolitical. All of those are outside market events, and they do impact the market. But outside market events tend to have short-term market impacts. Inside market events tend to build trends, which are your fundamental and technical data components. So they work together for trading and for you becoming a better investor. And as we look at this, one of the things that we have found is that, I'm just going to put SPY up here, which is the S&P 500 ETF. And if you put this up here, and for those of you studying any technical analysis and trend analysis, we all see trends, we see patterns within it, and you get used to that. You start locking into those things the more you look at charts. But the key to me is I want to take advantage of the market when it's moving up, and I want to take advantage of the market when it's moving down. And when it's creating a pattern, which is when people study technical analysis, it amazes me how much emphasis we put on studying pattern development for breakouts. Patterns are stock's waiting room. In other words, when patterns develop, they're nothing more than a waiting room for the chart to decide what it's going to do. And you can see right here that the S&P 500 on SPY was trading well within a trading range, and then it eventually broke down out of that trading range. So this is a waiting room for the next trend to develop, and this happened to be a downtrend that developed, and that's all it is, and that's a channel. And here you can see right here a reverse head and shoulders pattern and a neckline right here, and as that broke above the neckline, it created the next pattern to the upside. So you have the two shoulders here and you have the head, and so what happens is you break out, you move to the upside. That whole thing right there is a waiting room. This is a waiting room. That's all it is it's a waiting room looking for the next opportunity or trend to develop in the market. So that really is, I think, a key fundamental element for people that look at technical charts to understand and walk away with. And when we look at tonight how these pair trades are set up, we're not trying to change anything. We're just looking for how to manage risk. We're looking for how to manage opportunities. And that's what I did here. So I want to go back and I'm just going to look at why or how some of these things work. And this is the red line, as you can see, is TLT. The white line is SPY. What are you looking for? Historically, we know that if stocks are going up, bonds tend to go down. Not always true, not always going to be true, but let's just use the 80-20 principle and say that 80% of the time it is true. That if you get an accelerating market to the upside, then what you're generally going to see is bonds moving down for two reasons. One is as stocks escalate, the Federal Reserve will try to slow things down by ratcheting interest rates up, which tends to push bond prices down, because as yields go up, bond prices have to go down to equate to current yield values on yields to maturity. So that's a simple rationale as to why that works. It takes progression of time for that to happen. It doesn't happen in a short-term period. Why over a 5 or 8, 10-day period, which is what we're looking at right here, why would that be true? Well, the reason it's true there, I believe, is you're seeing rotation. You're seeing money that at one point prior to this period was fearful. In other words, it was afraid. It wanted to be safe, so it went to bonds. That artificially pushes the price of bonds up. And as that fear evaporates or comes out of the market, and we're willing to put fear or risk into a portfolio and buy stocks, what happens then is money comes out of bonds, goes to stocks, takes more risk. Bonds will tend to go down in value because money is exiting, and stocks go up in value because money is entering, and that's momentum. That's all it is. It's plain and simple. I can be more complex if you'd like, but I think that's a simple explanation of why it works, and that's why pair trades work a lot, is that there are lots of things that we see that do change, develop, and move. So all we're looking for is ways that we can find and or match these. Some of them are off of things like this, SPY versus TLT. Some of them are as wacky as UNG, which is natural gas, versus KOL, which is coal. And you say, why would they diverge from each other? I don't know, but they do, and they have for the last year and a half. Now, that may break, it may fall apart and never work again. It's not working right now, but it has worked going backwards. So those are the kind of things that we look for. You know, TLT versus retail. Why would that work? I don't know. But I do know I have my opinions as to why it works, and those are the kind of things that we look for. Are where are we seeing things, like EFA, which is the EFI index versus the emerging market bonds. It works. Walmart's a barometer for some relative to the economy. So if the economy is picking up, things are looking good, then money flows towards Walmart. Or flows out of Walmart because it's a discount retailer. People tend to think that it doesn't do as well during, bullish economic cycles as it does during flat to declining economic cycles. Does it work? Yes, it does. All those things are out there. So all we're looking for are paired plans. So there's two distinct groups of paired plans that are trades that we start to look at. One is the obvious ones, the tried and true seasonal things, the things that have some historical bent to them. The other is by looking at what's going on relative to the scans that we do. And I want to go back to this other page here just for a second. And what you see here is we have a basic ETF scan, and all we're looking for in this scan is what's on the top versus what's on the bottom. In other words, what is moving higher versus what is moving lower, and we leg into it by time frames. In other words, so if we look here, this table is sorted by percent change for today. So that's today's percent change. Whatever's leading it is leading it. If I click on it again, it's going to reverse it, and those are the laggards or the losers. So what we look for on today is what's leading, what's losing. And then we go out another 5 trading days and we rerun the sort or the scan, and we want to filter through and find out if it's true. Is it working? Then we can go out 10 days, we can go out 21 days, we can go out 90 days, we can keep clicking this out as far as we want to go, and we start building our own pair trades based on what's moving up versus what's moving down, and how and which of those makes sense as to being diverging from one another. Does it make sense economically and or any other fundamentally? Is it something that we see? In other words, an interesting trade that we've tracked for years is the price of coal versus utility stocks, because utility stocks are the largest consumers of coal. And if coal prices are ratcheting up, that's a negative for utility company earnings, which would push their prices down. So coal prices move higher and the utility stocks move lower. It's just that simple. So all we try to do is find logical paired trades, and that's what I'm going to go through tonight. So the first one that we actually are going to go and look at is SPY versus TLT, and we'll walk through this and how it works. The aqua colored line there is 0. And if you go up here, that would be about 3.5% is what you saw TLT go up off of that pivot point. And on the downside, you saw the S&P go down roughly 5% on the downside. So up 3, down 5, and that's where you get your risk parameters to compress together and give you less risk in the trade. But the point is getting into the trade, 1, getting out of the trade, 2, and managing the trade, 3. And that's really where the crux of this is. Anybody can set up paired trades, but the question is, how do you get into the trade? How do you manage the trade? And then how do you get out of the trade? And what I wanted to do is kind of draw on this chart a little bit. And you can see that right here is the day that we get the mark, these two start to separate. And what you're looking for is the entry point. And the entry point is going to be defined by moving up 1% off of the pivot point. It could be defined by moving 0.5%. You could use Fibonacci retracement as an example where if you wanted to look at the Fibonacci using Fibonacci lines, you could use those. I mean, there's any number of things that you could use for your entry signals relative to getting in and out of these. So the key to me is, how do I get into the trade? How do I manage the trade until I get to an exit point? And you can see right in here are your 2 turning points. So there's the turning point, and here's the turning point. And the question is, how far down do you want this to go before you hit the exit points? And because you're short SPY, how far up does SPY go before you cover your short into the trade? So the key to me is, how do you get into the trade? How do you manage the trade? And then how do you get out of the trade or exit the trade on how these are set up? So that's what the model has really designed, and that's what's taken really the most amount of time in research, is not so much the entry points. The entry points are pretty well easy for me from a standpoint that if I want to get into a trade and I'm willing to put it, I'm willing to see it move, let's just say 75 basis points or 0.75% off the pivot point as my entry point, then that's pretty simple to do. What's a challenge is how do you manage these trades, because now you're managing two positions and you're managing them in opposition to each other, and what we have to start looking for are there signals that come up on a consistent basis that will tell us where to get out, and the answer to that is obviously yes, or we wouldn't be doing this. And then the other side of it is how do you get back into the trade once you've exited. And so that's really how we built all of the strategies relative to this. So I want to go back and look at how some of these match up. Now, these are some unique things that we found. One is natural gas versus oil. For whatever reason, over the last, I want to say maybe a year and a half, we've seen natural gas and oil diverge from each other, like right in here, in this little area right here. And what's happening is that when you start to look at this, you find a lot of areas like this that are very true, and like this, I mean, you start getting areas where natural gas and oil actually diverge from each other very symmetrically, and you can pull this back to any time frames, and what you'll see in here are periods like this where you've got movement. Let's put the ruler bar back up here so you can see what the percent moves are. And you can see that natural gas moves up here as much as 11% away from oil, and then you can see that oil moves down more than 7% away from natural gas off of that same point. So you could be short natural gas and long oil. It's very interesting what sets up TLT versus XRT. This is bonds versus retail stocks. You see a very similar pattern here throughout this same type of a scale, and that you start to get movement away from each other. And that's what a lot of the testing of this was looking at. Where are the paired trades and how do they set up? I mean, that one to me is, I think it's fascinating, some of the correlation that we found in some of these. And if we put the ruler back up here, you can see that XRT went up 6% when treasuries went down 7%. I mean, that's what I'm talking about, was that you're looking for these kind of anomalies in the market. Another one is EFA versus emerging market bonds. This is the EFI index measured against emerging market bonds, and you can see you start to get these movement points. Put the ruler back up here again so we can see what goes on here. And emerging market bonds never really do a whole lot, but look at they became a cross line for essentially for the EFI index, and what you got was a movement down on the EFI of down 3%, and then it was up 2%. Not huge swings, but they're definitely tradable swings that we saw there. And then this one is EWA versus TLT. What they have to do with each other, most of us would say not a whole lot, but in reality, when you look at U.S. Treasuries, they're such a dominant asset class globally. We tend to think domestically, but globally, the treasuries have a huge presence in the world. And so as a result, as our treasuries move, they do reflect divergence away from other markets. And Australia just happened to be one that we saw the most unique correlations of how they separated at certain times. Another one, this is Walmart versus the S&P 500. A lot of people have talked about that Walmart is a benchmark for the U.S. economy, which I think it is to some degree, but we started to go back and say, well, are there times where Walmart and SPY diverge away from each other? The obvious answer is yes. They're not as big as you would like for them to be. Still working a little bit on that one. It's not as clear as I would like for it, but it's kind of unique. This is one that I found really interesting, which is BND, which is the total bond market versus high yield bonds. And you can see that during this period of time, pull the ruler up here, you can see that while you had a flat line almost in the BND, J and K, which is the high yield bonds, you can see move 2% to the downside. And again, you're talking about bonds, so you're not going to see huge swings, but there are definite trades that work. And in this case, this is something that we're going to start using a little bit more with the egg. Is I've been looking for these flatline comparisons to some benchmark, being here bonds. So if I have BND flatlining, but I've got high yield moving, then I can actually, in the egg model, now be short bonds, and there's ETFs that do that, so we can actually go out and short bonds or short BND because of the volume is there in BND. It's a high volume ETF. It's very easy to borrow the shares in short BND in the egg. So we'll start doing a little bit more of that as well as we go through some of this. We'll actually use some of this in both the one egg and the two egg models. This one happens to be currency versus commodities. Historically, they should diverge from each other. We didn't find that to be as true as we'd like for it to be, but there are definitely periods of time where in here you can see movements of 1-2%. Either side of that on a pair trade would actually work very well. This one I thought was interesting in that you had XLU versus coal. Why would this work? I mean, when you think about it, XLU is utilities. The largest consumer of coal is utility companies. If coal prices are going up, that hurts the earnings of utilities. So as a result, what you find is that you will find discrepancies, not all the time, but you want to find it when there are discrepancies like this, where you've got the coal is going up 5% when utilities are actually flat. If we pull this down where it should be, utilities were flat, but you could be actually long coal. Again, that can flip over to the one egg trade. But we found this to be a very interesting picture. The more you looked at it, that you found periods where if coal prices were getting too high, then it impacted utility earnings, and you could be short utilities. If coal prices were falling, like we've seen recently, that's better for utilities. They tend to be more stable, and you could be short coal, and those actually have worked out as some unique trades. But then you got this is one that I found very interesting just for my sake or my view. I know some of you think I've lost my mind, but that's okay. This happens to be the center line. This has 3 lines on it. So the center one, the red line, is SPY. The turquoise line is SVXY, which would be short or would be long the VIX. In other words, you're going in the direction of the volatility index. If the volatility index is declining, SVXY will be going up, and VXX is the short-term futures on the VIX. So if volatility is spiking up, then VXX will go up with it. And what should happen is SPY should become the center line, which you can see that essentially it does. And you should get these two moving away from each other, which they do very well. And then you can be short VXX as it moves down, and you can be long SVXY. And of course, in that situation, people are going to say, well, why wouldn't you just be all of your money in one? You can, but remember, the issue of these trades is to hedge or dampen risk in this situation. So what you're trying to do is control where you're wrong. And that meaning, I know that a lot of you listening probably are never wrong on your trades, but I find that I am wrong periodically, and that when I'm wrong, I'm trying to get this, when I'm wrong in here, I want my risk parameter to be much smaller, maybe 1, 2, 3, 4% at the most, so that when I'm right and it goes up 20% and down 18%, that I can capture this. This is the most volatile pair that we found, and it gives the biggest swings of returns of anything that we found. And so we've been working on, obviously, how that works. And then another one, the one last one just that I'll throw out here that I find, how I got to this one is obviously home builders. If interest rates are going higher, you find that housing slows down, and that should impact, you should have discrepancy or divergence relative to the home builders versus treasury yields. And what you find is there are a lot of periods that's exactly true, where you can see here that the home builders fell 5% when the bonds actually went up 5%. And that's what you're looking for, is that same type of discrepancy. And I found probably hundreds of these out there that I think are unique tools. And these are all things that we've set up for the actual trading of the two-egg strategy. And all we do is every day I'm going in and I'm filtering the paired list, and I'm saying, all right, which ones of these are setting up, which ones of them are not, what's hot pairs right now, what are cold pairs right now, and then that's how we're going to actually trade the actual model, is to balance it out off of what's going on. Now I want to go back over here and I want to look at something that I think most people, I'm going to say that I think you're familiar with this. If you're not, then this is something that I would highly recommend that you get familiar with. And that is, over here is our basic ETF scan. And I've shared this a number of times, so there's no magic to it. And the scan essentially takes all 1,360 plus ETFs that are out there, and all we're looking for is essentially positive ETFs. In other words, that the trend line is moving up. And so you will find that if you went through this, that the Qs are not necessarily going to be in here right now for two reasons. One is that the Qs are currently trading below their 50-day moving average, which is part of the filter here. Part of the filter is for this to, pull this up so you can see it. Part of the filter is that I want it to trade above the 50-day simple moving average. If it's not in there. I want the minimum ETF volume to be at least 100,000 shares, or it throws it out. And the ETF has to have existed for at least 250 trading days, which is 1 year. I want 1 year of data of most ETFs that I'm going to buy. So we set the filter up so that you've got a positive momentum in the ETF. And so it's just a simple basic scan that all we're looking for is what's leading the market. And of course, part of this is going to be short ETFs. And so you got short ETFs and long ETFs. And what you can see is going on today is that you can see the long silver trade. There's different things that are going to come up out of this on any given period. So if we go back and we sort this by the percent change for today, you can see that the Gold Miners 3 times Bear Fund was the number one performing asset. So what we look at is this, is that you can see this box right here, it's highlighted. You can see it comes up as the percent change for the last 5 days. And what we want to see is sort this, and what has been the leader over the last 5 days has been the long silver trade, 3 times leverage. But you can see then we've got its filter where I can scan it by 10 days, what's been leading. And again, the same fund essentially is leading there. And then I got it for 21 days. And I can filter through all of those periods. And what I'm looking for is where is the leadership in the market. And then if I want to flip this upside down, I can look at what are the laggards for the last period of time, whether it's last day, last 5 days, last 10 days, last 21 days. So I can look at this and I get to see who's winning, who's losing. And that's where you're going to find some of your best paired trades, believe it or not, is what's happening right now. Is that you've got, just an example here is look at this. Let's go back to SPY you can see the pivot point is right here on the 15th. And that was, roughly a week and a half ago. We got a new low in the market. We tested it and it bounced off of it. And now it started to move up. I want to know since this period, which is the 15th. So I got 1, 2, 3, 4, 5, 6, 7 trading days. I can come in here. There's a tool in here that's called custom date sort. I can go over here. I can draw onto this. And I've got the last 7 days, the S&P 500 is up 3.41%. And then I can actually now sort my list by this. By clicking on it, I add a column right in here. And I'm going to pull this chart over so we can see it. And there's that list for the pivot point, and I can see which of these are leading off of this. And you can see the VIX is part of that. You can see that the silver keeps coming up everywhere, ultra silver, ITB, which is home construction, home builders. You can see Germany, water resources, and you start to see things come up that sometimes you don't really think about. But that's the fun of this, is that you start to see what's moving the market. And that's where you start to develop your better trades out of this, is what's leading and what's lagging off of this column based on my pivot point, which goes back to what we were talking about with the sector rotation strategy right here. The reason we built these tables, and we have offered these on the website to people for, I think it's $40. My brother can probably tell you the price of them, but that's why we built that table, is that you can start to see rotation and movement of the market. And that's where, to me, as an investor, that this gets to be fun. That's where it starts to be, wow, I can actually see the market moving. I can see it real time. I'm not so hung up on technical analysis to the point of, is that really a double bottom? Is that the pivot point? I broke above the 200-day moving average. Do I have enough volume? Did I get divergence in MACD? I don't wear myself out. I'm looking for what is moving the market, and then I'm trying to match it up the best way that I can for the best possible trade for the least amount of risk. And to me, that's the ideal. I've been doing this for way too long. 31 years I've been trading money. And one of the things that I have been on a mission the last 2 years about is simplicity, is that you have to simplify this. The markets are getting way too vocal, is my way of defining it. And what I mean by that is it's getting too noisy. There's too many things going on. What worked 5-6 years ago with swing trading doesn't work quite as well with swing trading today. I think it's a lot noisier. I think it's a lot less predictable. You're going to get periods like we had earlier this year, where we got into the June 4th bottom, if we want to say exactly the June 4th bottom, up through the September 10th, 12th, 15th tops. Some of those trades in there worked extremely well, but we haven't had a lot of that over the last couple of years. We've had a lot of noise in the market, and we're reintroducing the noise. What happened today in the market, we've brought Mitch McConnell back in. We brought, Barack Obama back in. We've brought Harry Reid back in, and we've let them destroy what they're trying to do as far as this quote-unquote fiscal cliff issue. But the issue is we're not getting any leadership politically to resolve some of this, and what that's doing is starting to disrupt the market. And when that disruption creeps into the market, you've got to look at where and how you can make money, or you got to get out of the way of it. And that, I think, is creating more. And that's just one snapshot of today events. That's been happening really, I think, historically, going back back into 2007. And those are the kind of things that I think have really changed the trading landscape more so than anything historically that I've experienced over the 30 years plus that I've been doing this. So when I look at this, what I'm looking for is, how do I match things up that are working, and how do I find things that are working extremely well? And that's the same thing as if you read the piece that I put out, I think it was on Friday or Saturday, on my notes about the retail space and some of the things that are looking up there. If you haven't read it, you can go back. I think it's still, I'll actually know that it's still in the notes. You still have access to that article. And that I want to go back to it just because one of the things that I put a lot of stuff on our website, and sometimes you miss some of the things that are out there, not intentionally, but we're all busy, and I understand that. But this is one piece where I think these are some actual trades that are setting up. And what I talked about here was, this came from looking at what's leading the market. XLY, let's put this together, the whole story. I know the screen doesn't move as fast as I would like for it to, so I'll try to make sure that I do this slowly enough that you can track along with it. Is that when we go back to this piece right here, when we came off of this 15th pivot point, one of the pieces that was moving very well was XLY, which is the brown line right here. And you can see that it actually was one of the leaders until the last 2 days off of that point. What was driving that essentially was retail, and if we put XRT up here, retail was one of the driving pieces of that. Now, as I wrote in the article there, one of the things that you have to be cognizant of is that retail essentially really is in a downtrend, and it hasn't really broken out of that. It's tried. You can see the last 3 days, we had the up day, a down day, and an up day. So the last 3 trading days, retail has tried to break out. And we got to that just by using nothing more than this scatter graph, which was to find that the leadership came out of here. It was the piece we liked the most heading into a seasonal period where retail tends to do better. And we thought it made sense to dig into that. And that's how we did this, was we dug into it on the article, which is here. So all we were trying to do is go in here and say, all right, what is driving this? And here's my opinion. Apparel is driving retail. Technology or electronics, I don't see any big electronics toy. I've read a lot of analyst reports that Microsoft, their new tablet is whatever they call it, Surface, which makes no sense to me. But their tablet's going to be the big thing for Christmas. Okay, yay. Microsoft has never had a really successful launch of anything, so if this is it, I'm going to be wrong. But, and I'm willing to be wrong. But I think apparel is where you're going to see the biggest pop, and that's where you're going to see Abercrombie & Fitch, Aeropostale, Gap, American Eagle, AEO is a great stock in that space. I think that the apparel is really a great play, and I don't have time to dig into all this and show you how we got there, but you could take XRT and you can essentially set up the trade or the scan within here, and you can actually go through and look at these. And I have a scatter graph that I've built now that actually has, I think it's 10 stocks that we're tracking against the S&P 500 relative to what we think is going to see where we can get this right now. But what we did was we built a scatter graph to track all these, and what we're looking for is the apparel to break out. The other thing is the big box, and I think the big box winners are going to be Macy's, Walmart, and Target, which I didn't put Target in there. But the thing that is important to me is that when you get into the big box, I think those 3 are the winners. Macy's probably one of the best run companies out there. Walmart, I think is going to win. They did a lot of things right. They did the layoffs. Got the Twinkies on my mind. But when you look at the fact that they did layaways this year, I think that's going to help Walmart tremendously on the bottom line. I think they're a big winner for Christmas, and I think that Target is right in there with them. I went to Target today at lunch, not so much on a researching mission, but to get something. But when I walked in there, today is Tuesday. It's November the 27th. We're 4 weeks from Christmas, and Target was packed. And right across the street is Walmart from where I live, and the parking lot was packed. I think both of them do well. I think Macy's does well. And I think 2 wild cards for Christmas that could be the Grinch stories are going to be Best Buy and JCPenney's. JCPenney's, I think that they've gotten way oversold. I think they do well during the Christmas season. I think their launch for what they're trying to do with their new product, the way they've designed their stores, all of that filters out. And I think if anybody wins the electronic battle for Christmas, it's likely to be Best Buy, just because they're going to be willing to discount and sell product just to get people in the stores. We've already seen it with the Black Friday, Cyber Monday. I don't know. We had names for all of them: Yellow Wednesday, Brown Thursday, Black Friday, Cyber Monday, and now we had the day after Cyber Monday, Tuesday sales in my mailbox from Amazon. So God knows they're all going crazy. But I think that this is one of the areas that we're looking for the opportunity, at least in the short term, as to how this will all pan out. So I think that the key right now for me with this two-egg strategy, if you will, is really trying to get this to the point where it is working on an ongoing basis. So I want to go in and I want to look at the actual model. So if we go to the two-egg model, one of the things that we did inside of this is that the model tables always look the same. It doesn't really change. And what we're looking at relative to this is I want to show you right now what's on the watch list essentially, and what's on it is TLT versus SH. And I'm kind of stuck on this trade right now with the TLT and SPY because it's working really well right now versus some of the other paired trades that we've looked at. And so for the month of November, this has really been the best pair trade. We've traded it twice already. This is the third setup. And the setup is for this. Let me go over to the chart if I can here. And pull up this. What we're looking at is that we've got this separation back here, and that's where we hit our exit points on this intraday in here. So on Monday, we actually hit our exit points and exited our trades. And now what we have is the setup for this to actually move out. And what we're trying to do is figure out how we can move beyond where we are right now into the trade again. So what you've got is, in essence, the white line, remember, is SPY. And SPY went up and it's rolling over. So what we're looking for here is SH, which is the short trade. And up here is TLT, which is the long bond trade. And I want to go back if I can, and look at TLT, and I want to see what you're seeing on the actual chart itself. And what you saw is TLT actually pull back to support. It actually moved right down to the 124 level on Thursday of last week, held it, and now it's bounced off of it. I think 125.50 above that is the entry point for TLT with a 127.20 target on TLT. Now on SH, which is the opposite side of this, you can see that it caught support right in here at 34.60-ish, and it bounced off of that. And if it clears out of this 34.85 range, then it's got a chance to run back to 35.85 or 36. You've got the 200-day moving average right overhead, but that's the paired trade setup. And I go back to the chart just so you can see it a little bit clearer than you can on this type of a chart, a comparison chart. But I think that really is where we are right now with it.
Okay, what I really want to do in conclusion to the webinar is I want to try to go back through what the objective is of one egg and two egg, how they kind of work together, how the models were built, but also how to use the website in conjunction with those. So the key for me is that if you are a member, the member homepage is the easiest place to go to be able to see everything that's available to you as a subscriber, and that's where you tend to want to flip back to, because you can see the notes, the latest note, you can see the latest on the research page, and then you also have the video pages here, so it allows you to see each of the parts of the whole thing. So that gives you an overview relative to the daily updates that are on the site that you can access. When you're looking at the models, you can flip right here to one egg or two egg, and since the two egg is what we're talking about tonight, what I wanted to do is look at this. We already went through how the trade sets up and all of that, but the tables to me
we designed these to try to be as simple as possible so that it's a quick view of what's there and that you can quickly look at what the post is relative to the actual trade itself. And then in the center of the trade, or in the center of the table, is going to be the rationale behind the trade or the post, and that's where you can look at and say SPY turn lower, second day, blah, blah, blah. It's going to give you the rationale behind it, and then it gets updated as the time goes by, so you're going to be able to see what is progressing. And if this is an intraday update, this column right here would say like 2 o'clock or whatever time I post that. I'm not asking you to look at it intraday. It's just telling you that I updated something on an intraday basis. If it's left blank, it's an end-of-the-day update, just so that you know how to look at the table itself. And the key to me is that you use the table as simplistically as possible without feeling like you've got to always be watching it. Now, the other thing is a couple of questions that I've been asked about this is, do both the trades get acted automatically? The answer to that is no. We looked at it that way. We traded it that way, and what we found was we were taking bad trades. So what I have on the screen here is a trade where intraday on the 27th, this was the setup. So coming into the trading day on the 28th, you can see that we took the entry on SH, and however, TLT is on hold for now because it had gapped above it. And going back to the chart, we can see that pretty simply in that let's just pull up TLT. The entry on TLT, let's pop into the intraday chart there so you can see it. The entry was 125.50, which is right here. You can see that they gapped up and opened at 126, so we were willing to wait. Well, as it came back down, it went through it, went lower, came up back around it, but never really got going anywhere. And if you looked at this, what you saw on the other side of the trade was SH, which we'll look at in a second, was actually rallying higher, which was telling us that this was probably going to move lower, which is what it did all the way to 125.11 into the close. Now, on SH, you had the opposite effect in that it gapped right to the trade. So we took the trade at the open, went higher, reversed, went all the way down, and actually hit the stop intraday. And that means that we actually got in it in the morning, sold it in the afternoon, and we didn't hold the position. We took a loss of 1%, a little over 1% on the trade. And so what happens is if I automatically turned around and bought TLT, so I got the entry at 9:30 on SH, I would have turned around and bought TLT at 125.50. It closes at 125.11. It compounds the loss on the trade, even though we never really got a clear entry signal on TLT like we did on SH. So we took half the trade, took half the loss, lost, I think, 1.3% on the trade. We can look at the archive. And you can see on SH that the actual loss was 1.17% or $1,155 on that trade. So that's why I don't do it. We found that to be true more than not. The other side of this is that, will we ever buy the other side of the pair trade? Absolutely. If it's going to work out, we track it, we'll buy it. There are I think there's another case here in the archives where we bought the trade on 11/17. We bought the short on the S&P 500, which you can see right here. The entry date was 11/17. Next day, we got the confirm on TBT to short treasuries on 11/18. So we paired the trade 24 hours apart, but we want them to fulfill. Each trade is set up on its own and then paired. So we're not just arbitrarily pairing these. They're being put together based as individual trades and not just a pair trade. We're trading them together to deal with the risk, but that's how they set up and that's how they play out. So I think that you have to be cognizant of it. And what if the other side of the trade never gets filled? Then it will actually trade like the egg. In other words, the one egg, it has one holding. We trade it, we manage it, we do all the same things that we would do as if we had one asset. And then we manage the risk of that asset going forward and then wait for the setup for the next pair trade that we're going to take. So that's all we're doing is we're pairing trades that we think work together and deal or mitigate some of the risk. Now, another question that I had was, Jim, how does this actually mitigate risk? It seems like you're compounding the risk by buying two assets. Well, on the surface, the answer to that is yes. But let's look back at how this works on the chart. And if we look at, let's just go back to TLT and SPY. If we go back and look at this trade setup, that one has worked. So let's go back a little bit into the trade and look at this right in here. And let's say that we got into this trade based on this move. So we ended up into SPY. It broke above what we were looking for, blah, blah, blah. But we're in the trade. Look at what's happening. SPY on the, or TLT, I'm sorry, is the red line. TLT on the upside is moving higher. SPY may be moving down, so the trade's working, but then it reverses. SPY goes up, TLT comes down, and what you end up with is less of a loss because you're actually losing less on TLT than you may be losing on SPY, but they start to work to the point where if they're jumbled together like this and the trade isn't working, it really negates the risk. So your beta coefficient of each side of the trade is very different. The beta on SPY is going to be much higher than the beta on TLT, and that's what you're looking for, is how do you dampen the risk by pairing the trades. And so it does work to do that, and it's something that we've tested really going back for almost 5 years. So we've looked at this every which way that we possibly can. Other questions that I'm getting is, how do you choose the entry? How do you choose your exit? How do you choose your stops? All of those things. I guess I could go into all that and you could go off and do it yourself. And I'm happy for you to do that. I'm not trying to hide anything. But I think what the reality of that is that we don't really go through it as much as probably some people would like for us to, because what we're trying to do is in essence, by building these models, is getting people to start thinking for themselves, start trading for themselves. And that really, I think, to me, is where the rubber meets the road. And so I'm going to give you some simple rules of thumb to look at. And that is, this chart is designed as a picture of what a pair trade does in its perfect format. And that is that they break out, they diverge from each other, and both sides of the trade works, one short, one long. And whereas what we look at is the same thing, that if this sets up, then I want to go back to the chart and I want to look at, and I'm going to put up here SPY, and I'm going to say, what about this chart works as a trade on the upside or the downside? And in this situation, we see this setting up as a short, and the fact that it hit against resistance. You can see that volume at price is very heavy there. A lot of things there that show resistance. We've had 2 bad days of consolidation. We've seen things kind of loosening up a little bit on the downside. And since that bar doesn't look like it actually went down for the trade entry, what I want to look at is to flip back to the 5-minute bar here and look at what happened. Is it did work. It actually moved down. What happened right here was Mr. Bonner, who is the Speaker of the House, and Harry Reid, who's the head of the Senate, and the President all came out and played nice with each other, and the market liked that relative to the physical cliff issue, and the market reversed intraday, negated the trade, took us out of the trade. But those are things you can't account for. I can't account for news, but I can account for what I see on the charts. So the entries are purely technical. I'm not going to say it any other way than it's just a purely technical entry, and it's defined based on criteria for getting into the trade based on whether it's moving averages. It could be any combination. And the reason we don't say it is that we have probably 9 to 12 different entry signals that we use based on technical analysis, based on how it's set up. So if I say every time it's going to be this way, It isn't going to be that way. What is important for you to understand is that I taught mathematics for, I guess, around 8 years between high school and college. And I remember teaching kids, different formulas, quadratic formula, different solutions for things. And one of the things that the kids would always ask me is, Jim, is that the way you always do it? Well, in mathematics, there are certain rules that you follow, and yes, there are certain steps that you follow. But if you don't learn to think outside the box of how to solve a problem, then you're always going to want to do the same thing the same way. The market doesn't react, or proact any way, shape, or form repetitively, and I get furious when people tell me that it does. The market always has outside events that create bars on a chart. It's not just what's going on in the market. It's not the technical data. It's not just the MACD, the stochastics, the moving average, the price bars, the candlesticks. It's not just those events that move charts. It's outside market events. I mean, we just made reference to the fact of this physical cliff issue, and one day they're arguing with each other and we're not going to resolve it. The next day they're playing nice with each other and the market likes it. That's an outside market event that creates bars on a chart that, when you go back and look at them historically, are very hard to recreate, and they're very hard for you and I as traders to understand sometimes. And that's why I say that the entry points are very disciplined to what works for us, and I think that's what you've got to realize with that. The same is true of exit points, in that we use a lot of different strategies for exit points, and it really is based on the market environment that we're in. The actual holding components of how we manage the intraday stops and all of that, again, is very subject to what the market's doing. And that's why I love IBD to death. I love all the stuff they do, but to arbitrarily set a stop at 7% on the downside doesn't make a lot of sense to me. Yes, it's a discipline. Yes, it's a rule. And it's, but my dad always told me that rules were made to be broken, except for his. In other words, I was allowed to break other people's rules, just not his rules. And I think that when you get locked into rules, you really do hurt yourself as a trader. I think that trading is as much about intuition as it is about knowledge, and that you have to be in tune with the market, and you have to be intuitive about the market, and you have to have strategies that work within different market environments, and that's the key. In other words, to me, my entry strategy, let's just draw a couple lines on here, and I want you to kind of understand what I'm saying here, is that my entry strategy for a V-bottom reversal is going to be very different than my entry strategy for a declining channel breakout. I mean, both of those have different entry strategies because they define themselves differently. So when I say I'm looking at a pair trade, yes, I'm looking at it, but my entry is still going to come back to the chart. It's still going to come back to the market environment we're in, and it's still going to be driven ultimately by how the market reacts to what we're doing. We're just trying to pair a trade, hedge a risk based on what's going on currently in the market. So for what all of that's worth, I think you have to be intuitive as well as disciplined logically about entries, about exits, and about how you set your targets and how you manage the in-betweens. In other words, we call it managing the in-between, between the entry and the exit. You got to manage the in-between of the trade. And I believe wholeheartedly, emphatically, and I'll stand on a box until the day I die and say this, that 10% of the trade is the entry, 10% of the trade is the exit. 80% of the trade is the in-between, and that's really managing what's in between your ears and the emotions that you tend to go through as an investor / trader on everything every day and how it works, because greed works against you, fear works against you, the emotions of the trade, the emotions of the market, and the emotions of losing money are real. And when your money is really invested versus just paper trading, it begins to shift things around a lot more than you think. And I think those are some key data points that we all have to focus on and go through. So the two-egg strategy, that's kind of how it works. I want to review the one egg because a lot of people people have asked me about it again. And the one egg strategy is a pure momentum strategy. And what this does is scan 1,360 ETFs every day. We filter through it based on different criteria of what we're looking at right now. And just to based on what's going on, based on this recording right now, is what the market is doing is it's bucking a downtrend. So here's the defined trend line right there. And the market is deciding whether or not it wants to buck that trend and actually reverse and create a new trend. And so the momentum right now is off the bottom. So we have what we call bottom scans is what we'll shift into with the egg. So in this point in time, we'll look for what we call bottom fishing scans, and we look for a scan of where is the acceleration off of the bottom. And where we look for acceleration is a lot of different ways. Moving averages are one, so that is a key component, is which moving average are we looking at right now? Do we want a moving average cross? Do we want the 10 to cross over the 20, the 10 to cross over the 30, the 20 to cross over the 50? In other words, what are we looking for relative to the momentum? How fast of momentum do we want? And then we start to accelerate our scans based on what we see accelerating out of that bottom. If we're looking for a short side of the market off of tops right in here, same type of thing. You just flip the inverse. You're looking for downside acceleration off of tops. So a lot of different things as to how the egg is set up. And our trading is basic. It takes what the market's doing and it looks at how to scan it. If I pull up my scans, I probably have 70 or 80 different scans that we use. We have, I would say, somewhere in the vicinity of 120 different strategies for trading that we've developed based on different trading environments. So we're always matching those strategies. And understand, I've been doing this for 31 years, so it's not like I just started this yesterday. And I don't expect you to get all of those strategies. I'm not going to try to share them with you. That's why we've tried to dumb down what we do to the point of simplicity and explaining what's going on in the market now. And that's why the nightly commentaries are really about what's going on in the market now, what's it impacting, what sectors are moving, what sectors are not moving, and how can we trade them, how can we benefit from them, and all of that. Those are the kind of things that I think are of value that give you trading opportunities off the lows. The most recent one, for those of you who are not subscribers, has been utilities. And you can see the perfect bottoming setup right here. So what we're looking for is a bottom reversal. And so as we get it, you got kind of a double bottom formation in here. You got to break above that double bottom right in here around 34.50, so you get an entry trade. The actual entry trade on XLU was 34.50. We own it right now. We're in it. And if it continues to play out, then, this is in the sector rotation. It's also in the S&P 500 model. We own it in both. But what we're looking at is the sector rotation would like to push things longer term. We're going to take the trades where it sets up, but we're going to try to push the trade longer term. The S&P model is going to take it for the trade that it is. We're going to try to bang 1% out of the trade, 2-3%, keep it for as long as we can, and get out of it. So it has exit signals that are a lot quicker sometimes than what we look at with the sector rotation model. But now, as this trade starts to develop, if I can get the 10-day moving average, which on this chart is the pink line, if I can get that to accelerate above that gold line right there, which is the 30-day moving average, then you've got an acceleration within the utilities that makes it work even better. Things that we don't do a lot on the website is the drill down or dig down into the utility stocks and find who are the leaders. And, just because we've been looking at this, we would look at, like NextEra Energy was one of those that was accelerating. You see the reversal there on the last bar, didn't really follow through. But like Duke Energy is following through. And, so we start to look at where they are. And how do you do that? I mean, really, trading is not... Finding trades isn't as hard as trading, if that makes sense to you. I think it's harder to trade than it is to find trades. In other words, you got to fight that emotional component of getting in, getting out, and managing the trade more than finding trades. I think a lot of people are very good at finding trades. They're just very poor at managing those trades relative to the entry, exits, and targets like I just talked about. But if I go to the utilities Spiders ETF, and I click on that, which all I did was type it in, and you can see how I did it. and you can rewind the video and watch it, but there's 31 stocks inside of XLU, and I can sort, scan, and filter these and look for the leaders, very simply with this, by just flipping through the charts and seeing what, the ones that look just like XLU are the reason XLU looks like what it does in the pattern that's set up. What I'm looking for are the ones that have accelerated away, like GAS there, and you can see NRG Energy. You start filtering and you're looking for the CMS. You want to look at those are the stocks that I'm looking for the acceleration. And then we have ways that we'll go back and look and filter through those. So PPL. But the key to me here is in all of this relative to what we're doing on our website is educating you. We're trying to get you to become a better trader, not by giving you a trade, but by teaching you how to trade and how to see the markets, visualize the market, and experience the markets on a day-to-day basis. So in conclusion to all of this, as far as this webinar is concerned, the pair trading for me is nothing more than we've set these up to find the opportunities, and we're looking for where they cross. We're looking for different setups in here, and that's all this is a way to share those setups, and we'll give you, at the time we make the trades, we're going to share with you why the entry, why the exit, all of that gets shared, so it's right there so you'll learn how to trade instead of me trying to give you some hard and fast rules that I don't even stick to unless it's disciplined to the environment for why I bought it. If I bought it based on a bottoming formation, I want to stick to that discipline. If I bought it for a rolling top, I want to stick to that discipline. I'm going to use the discipline that gets me in and out of those trades that work successfully over my career, and not just try to give you hard and fast rules for every trade. They don't work that way, and that's just, I'm going to stick to that as far as I'm concerned. Now, you can you have opportunity if you'd like to look at the website for the next 48 hours. You just need to send an email to Don at sectorexchange.com, DON at sector, SECTOR, exchange.com, and he'll sign you up. For that, if you're past the period that this has been posted on the website, you'll have to beg for that opportunity. But, I don't know how stringent he is. Sometimes is much worse than others. But I think you want to look at it from the standpoint that what you're trying to do is learn about the website, take advantage of it. We offered $200 for the first quarter of the subscription. It's normally $250. If you're already a subscriber, you can renew for another 90 days for $200, and we'll extend that at the end of your subscription period as it currently exists. If you want more information, you can call the office. You can call 1-800-369-5759. We'll be happy to walk you through any of this, and we'll give you pretty much anything you ask within reason. We're going to try to help you with this. You can email me directly to jim@jimsnotes.com, jim@jimsnotes.com, and I'll be happy to answer your emails. But the key to me here is that this is a great tool. Use it as a tool. It's not something that is the holy grail. I'm not trying to present it that way. One thing, any of you who've been around me for a period of time know I don't tout performance. That's not something that I like to do. Our focus is about discipline. It's about trading. It's about learning. It's about becoming a better trader. If you learn those things, performance will take care of itself. What my performance is relative to any period of time is me being disciplined within those times to take advantage of things. And you're not in business for 31 years if you're not successful at it. That's one things I can tell you. And you're not around this business for long if you're not good at it. So our focus has always been education. It's been that way for 30 years. So take advantage of what is out there. If you have questions, again, email us, call us. We'll be happy to help you. So with that, I hope you guys have a great evening, and we'll talk to you next time.